Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we talk to individuals, businesses, and organizations who are taking the lead and whose actions are impacting the well-being of their communities and the world at large.
Welcome to Money with Mission. Today, I am excited to have Michelle Connell, CFA, from Portia Capital Management. This one's a little different, you guys. Ms. Connell, or Michelle, works a lot with stocks, private equity and stocks. She is a founder of Portia Capital Management and uses her experience and knowledge as a former mutual fund manager. Her company is dedicated to finding the best investment solutions for you, and her knowledge, expertise, and industry contacts allow her to offer exclusive access to alternative assets and the top emerging market funds you wouldn't get anywhere else. Welcome, Michelle. Thank you so much for coming on.
Thank you for having me.
You're welcome. I'm excited to talk to you. We usually talk mostly about real estate investing and that kind of alternative asset. Tell me, first of all, let's go back up to CFA, because I'm not sure everybody knows what a CFA is or what that means. Talk to us more about that.
A CFA is a chartered financial analyst. It is a designation that typically takes 3 to 5 years postgraduate. If you want to be an analyst or a portfolio manager on Wall Street, manage money for a mutual fund, manage money for a pension or endowment or foundation, you get that particular designation. It is considered the platinum standard on Wall Street.
Okay. What's the difference between that and, like a financial analyst or your financial advisor? That's what people usually say. I'm going to talk to my advisor, my financial advisor. Tell me the difference, or explain the difference between who you are and a financial advisor.
A financial advisor is typically they are licensed through the SEC and through FINRA, and that means that they have passed a 6-hour exam. They have a very broad knowledge of securities and what they are. They do not value them from an analytical approach. They are more there to put together a portfolio that is suitable for a client versus someone like me. I'm actually valuing the securities within that mutual fund or that private investment. So my background is I was a forensic accountant, so undergraduate degree in accounting, worked as a forensic accountant for a while for a law firm, was a CFO. So I know the cash flows, and I look at when something is overvalued versus undervalued, and therefore I lose less. That's different than an advisor, again, that is pooling your assets based on how much risk you're willing to take and where you are in the life cycle of being an investor.
I think I understand that. So with you, would you more value different particular stocks and companies compared to the financial advisor who looks at, like you said, a basket full of things for you and tries to hedge your bets? Is that the difference?
How do I put this? Let me think. When you're a financial advisor, you're typically working under the umbrella of a brokerage firm, let's say like a Charles Schwab or a Merrill Lynch or Morgan Stanley, or a bank. You have a list of securities that you are allowed to use. You're given a list of mutual funds that you could use. And then you, based on a potential client's risk tolerance and where they are in terms of whether they're close to retirement or they have several years in front of retirement, they have basically baskets full of securities or formula, so to speak, that they can use to put that potential client into different mutual funds. For me, I am looking literally at the companies within a mutual fund, talking to that mutual fund manager to see what their thoughts are, what are they buying, what are they selling. And I have the ability to do that because in a prior life, I was one of those mutual fund managers that was buying stocks, individual companies, going out and talking to company management. My specialty was technology. So I would go to Silicon Valley and I would get to talk to the CFO of Intel, or get to talk to the CFO of Apple and understand what their companies were doing, what their future growth projections were. And therefore I could tell, looking at where the stock price is now, should I be buying it or not? Or did it have some upside from here? And so because of that background of 20 years experience, I can look at a mutual fund, look at their holdings, talk to their portfolio manager and see if what they hold, given where we are in the market cycle for like right now, we know we're heading into a stronger recovery next year, if those stocks have upside or if they have more downside. Does that make sense?
It does make sense. It does make sense. So a lot more analysis, it sounds like, on an individual basis than what your financial advisor would do.
Well, yeah, a financial advisor typically has 300 to 400 clients.
Mm-hmm.
Right now, I have about 38 clients. Their average client is probably about 50 to 100,000. Mine are much higher than that. And I'm also managing money for institutions like foundations. A financial advisor does not have the background or the knowledge to do that.
Okay, got it. That's pretty exciting, actually. So you work with institutions. I know you work with nonprofits. We were talking a little bit beforehand about one of the nonprofits you're working with, and how, I guess I want to understand how you decide let's take a nonprofit, any nonprofit you can think of, and decide how you decide where to invest for them.
Okay. All right. Well, I'll use the example. I have a large foundation that's outside of New Orleans. They're actually located in Morgan City. They're about $40 million. Every year, a foundation, in order to maintain their nonprofit status, has to distribute 5% every year to their constituents of their market value. Okay. If they don't, then they lose that nonprofit status. Okay. Well, obviously, you want the portfolio to make more than 5% because you want the underlying value of that portfolio. In my case, I want that 40 million to stay at 40 million, and I actually want it to grow so that it continues to make that 5% into the future and hopefully grow the amount of income. So I have to come up with a blend of stocks and bonds, a lot of that being private debt right now because bonds don't pay very much, and also using real estate. I have some multifamily paper in that particular foundation. I also have some venture capital investments with them, and I have to make sure that there's enough income but enough growth. And so it's looking at, from a projection basis, how much am I going to make every year in income, and trying to come up with an analysis of how much capital appreciation I'm also going to be able to attain at the same time. And my goal obviously is to make more than 5% a year so that corpus or that underlying principle grows so that I can continue to help their community. And on an inflation basis, obviously, I want that amount to grow.
Got it. Do they guide you at all as to what they want to invest, the type of investments they'll have, or do you kind of
No.
Go ahead?
No. When I started with them, they had financial advisors, or they had stockbrokers in New Orleans that had traditional portfolios. And that's very common for a foundation that's smaller, and smaller typically means a foundation of 50 million or below. I know it's hard to believe, but that's the kind of the cutoff. Mm-hmm. So they had mutual funds and stocks and bonds. Looking at how bonds have gone down in terms of what they can make into a portfolio, I educated them in terms of, okay, let's do something in multifamily, because we can make 6 to 8% income and potentially some upside. You have an infinite time horizon. We can do some private investments. And that's kind of what I do for individuals as well, because going forward, unless you're going to have an all stock portfolio, you need to have other things like real estate and private investments to take up the slack of what bonds have done in the past, whether it's an individual portfolio or an institutional portfolio. So it's been an education process. They didn't know what alternative investments were before I started working with them. And that's true for most individuals and organizations, unless they are very sophisticated and of size. Up until 10 years ago, it was the Harvards and Yales of the world. They were the ones that were known for having real estate and farmland and forest land, etc.
Mm-hmm.
Now it's just becoming more mainstream, where you have more real estate, you have more alternative investments for organizations, and individuals should probably go down the same path as well.
Got it. There's a lot to understand. There's a lot to understand.
That's why I like it, is because I'm always learning, because there's so many different things that are going on in the world of private investments. I mean, some of the organizations or venture capital companies that I looked at last year at a family office event in Florida, some of those organizations actually made devices that helped during COVID.
Mm-hmm.
And they're very scientific oriented, and to see that happen, it's very exciting. Or there was a venture capital firm in Silicon Valley, and what they do is they seed a lot of technology startups, because right now you can start a technology firm with so much less than you could 10 years ago, even 5 years ago. It used to take hundreds of thousands of dollars. Now you can start a technology company with so much less. And there's a lot of upside in things like that.
Got it. Tell me about, we've talked a little bit about in the past, sustainability and investments in environment and that kind of thing. How is that looking for people in the stock market and alternative assets? Well, how does that look for you?
Well, I've been doing some research in this area because there is more interest, and actually interest in ESG or sustainable investing has picked up during COVID. ESG stands for environment, social, and governmental investing.
Mm-hmm.
In the past few years in the United States, $1 out of $4 goes into investments that have the ESG or the sustainable investing label under that umbrella. So we're becoming more comfortable with that. Now, it kind of, interestingly enough, it really depends on an investor's age. If someone is over 45, it may be $1 in $6 that is spent in that umbrella or in that type of investment. If you're looking at a millennial, or younger, they are more oriented or focused on doing the right thing, being environmentally conscious or socially conscious, and it's $1 out of $2 for them. So the younger investor definitely wants to see their money going into areas like this. But the problem is that it's twofold. One, the disclosures that companies have to make in this area, publicly traded companies, there are no standards.
Mm-hmm.
So it's up to the company what they disclose to the public in their financial reports that come out quarterly and annually. It's up to them what they put in their notes. There are a couple of different standard boards around the world that are trying to come up with a world standard, but that's still in progress. So that's one problem. The second problem is you have mutual fund managers that are using different ways of determining whether or not something it should be fit as being seen as environmentally sound or a company that is socially conscious in how they do business. There aren't any standards there. So an investor really needs to look at how that investment firm is coming up with the screens to determine what is put in that mutual fund. And a lot of times, even the advisors that are selling those funds to investors don't understand what's beneath the hood.
Mm-hmm.
So an investor, they may get they're not actually come up with an end result that they want. They may be thinking that they're doing something that's good, for the greater good of society or values oriented, when in fact it's not. Let me give you an example, and this is an older example. Back in the day, I had a client that their son had helped start the first library on Microsoft's campus in Seattle.
Okay.
And the family was very environmentally conscious, which most people in the Northwest are. I'm from that part of the world. And they came to me and they said, we don't want any oil companies at all, but we don't want to own what the index or the Standard & Poor's 500 owns. We want to look at a few, and we want to look at some screens. And at the time, we didn't really have any strong screens in that area. Well, they went out and they did their own screening, and they came back and they said, well, we decided that we want to invest 10% in this one oil company, because at the time, that was the waiting for oil companies within the S&P. And can you guess what the one company was that they had me invest in?
I have no idea, Michelle. What is it?
BP.
Oh. Oh.
Yes. And so we all know how that played out, big oil spill, lots of lawsuits, but they screened, they said the right things within their financial disclosures. And fortunately for me, within my investment policy statement, I had the client sign off on the fact that they directed me to, invest in BP. But my point is, you just have to really be careful about what you own. So, and mutual fund companies right now, especially because of the demand, they want to come out with these products. And so you have the Fidelities of the world, the Vanguards of the world, the Nuveen's of the world. They're coming up with a plethora of these products, but you don't know what's within the hood, underneath the hood, in terms of the companies they own and how they're determining whether they're there for sustainable reasons or they're actually environmentally friendly, mm-hmm. or social, or doing proper governance. So it's going to be, unfortunately, the onus of the, determining if it's right for you or not and your values. You're going to have to do your own homework as an investor, and you're going to have to come up with strong questions for your advisor. Don't assume that advisor knows how those companies were selected.
All right.
That was a mouthful you asked.
That was, and I know, and I know a little bit about this, but I wasn't thinking about it along mutual funds. I was more thinking about as individual companies, but even in the individual companies who are started and they want to do well and they want to do good in the world. There's not a standard about what that actually is. Measurement is even difficult. So that it is at this point still challenging. So it's very interesting.
Well, so you have to start at the corporate level and what they have to do, from a disclosure and reporting standpoint, and then you take it down to the investment level. So you're looking at two levels that have no standards. And, the investor wants to do well. We want to be able to make the world a better place for our children, our grandchildren. We're doing it with the right motives. But keep in mind, right now, ESG and sustainable investing accounts for roughly $18 trillion in the United States of assets that are managed out of 51 trillion. It's a lot of money. So what happens when you have a lot of money? You have a lot of motivation to make money with fees.
Yeah.
And I'm saying that, against my own, but that's how, the world of finance and investments works. You're going to have mutual fund companies and investment companies. That's the hot dot right now.
Interesting. I read your article today. I read one of the articles you were quoted in today in the New York Times. And you talked about something that I hadn't heard about. M2, M like man, 2 money and it was, I believe it was talking about liquidity.
Right.
How is that measured? How do we know how much money is on the sidelines? How do you know that?
I know that by looking at what the Federal Reserve comes out with weekly in terms of what is sitting in bank deposits and in money markets. So
okay.
M2, there are different levels of money that the Federal Reserve measures. And one is just pure bank deposits, which obviously doesn't really count because it's not earning anything. Most people that have a little bit of sophistication are going to try to earn some money from it. So M2 incorporates not only bank deposits and cash, but also money market accounts.
Okay.
So that's liquidity. That is considered on Wall Street true liquidity. So when we're trying to determine how much money is sitting on the sidelines, we look at M2.
Okay.
And Chairman Powell frequently of the Federal Reserve refers to that as well.
I missed that altogether. So I was like, oh.
Okay. He's kind of boring, but a lot of people are like hearing him. He's, there's monotone,
Yeah.
Typical in my industry, monotone, boring white man, middle-aged, everyone, turn that off.
Yeah, I think, I won't go into that anymore. So,
I can't do that because I'm not.
From the article, then you were surmising that because of this amount of liquidity on the sidelines, the stock market was likely to continue or to go up next year because people are going to start coming back in.
Yes.
Is that correct?
Yes. Okay. During the pandemic, you watched M2 or that liquidity, that money sitting on the sidelines grow. You had a lot of people that were spending less, right? Because we didn't really, if you're middle class or higher, you didn't have a place to spend your money like you used to. You couldn't go out to eat. You really didn't have a need to go buy clothes, right? Or to travel. So there was more money that was going into bank accounts and money market accounts. We started at the beginning of the pandemic with about $3 trillion in M2, the cash, the bank deposits, and the money markets. We're now at about $4.2 trillion. That money cannot sit there and earn basically nothing for a long period of time. So you combine that with the fact that now that we do have the vaccines, we do have some clarity in regard to the elections. We're getting more clarity in terms of what can and cannot be done with taxes. So there's more enthusiasm towards the stock market next year. So instead of just seeing, this year it's been basically 10 technology stocks that have driven the market. 10, probably 5. 5 technology companies now account for basically 25% of the return of the S&P 500 this year.
Right.
So all the other companies haven't participated. So you have bank, stock that's down, bank stocks that are down still 25, 30%. You have oil companies that are down 50%. You have a lot of travel and leisure stocks that are down 20%. They have not participated. You even have some healthcare stocks that haven't participated. The belief is as that money comes off the sidelines and we, get a feeling of more certainty and more stability, more money will be going into the stock market or other investments. It doesn't necessarily have to go into the stock market, but a lot of it will. And a lot of it will be going into other private investments also.
And do you think people invest mostly in the stock market because that's what they know? It's easier. Why do you think people invest more in stock market than alternative investments like where I am in real estate and businesses and that kind of thing?
I think it's because of a lack of knowledge.
Hmm.
I think that is, and I will also say this, I also think it's laziness I'm saying that for my profession, because you talk to most people that are financial advisors, they don't want to do private investments because it's more paperwork, it's more compliance,
Hmm.
and you have to stay on top of it. It's more tax responsibility to your client at the end as well. I think I spoke to you earlier because my foundation has at least 10 private investments. I was responsible for their making sure that their K1s reconciled. I didn't issue those K1s, but I had to make sure that they reconciled for their CPA. Your typical financial advisor, they want it clean, they want it easy, they want a bucket. Sorry, they'll even tell you it's a bucket approach, where they want to give you a bucket of mutual funds instead of having to worry about all the paperwork of a private investment. But with that private investment, typically also comes more upside. So that paperwork and that compliance can definitely be rewarded for the investor and worthwhile.
Yeah. Thank you for your honesty. I appreciate that. That's enlightening to me.
If you're a financial advisor, don't come back at me, because I used to be one at UBS for several years. And so I've been in that closing, and I know the different sides of the financial industry. And and when you have 300 to 400 clients, there's no way that you're going to be able to handle all that paperwork.
Yeah.
You just can't.
Yeah. So, I understand financial advisors get paid often through their trades and through that kind of thing. Is that correct?
Yes, they also get paid through their trails, and they also can get paid through on the loads of their mutual funds.
Okay.
Okay, so like if that's why when an advisor is putting you in to a mutual fund or making some recommendations, ask them what share class they are, because if it's an A share class, they're typically getting a nice big upfront fee, can be 5 to 8%. Plus, they're going to get an ongoing trail for that mutual fund as well. And I will also say that there are certain organizations or brokerage firms that have lists of mutual fund families that they have reciprocal agreements with. Like there is one that's very large in the United States, and I won't even give them initials. I'm not even going to do that.
Okay.
They had an agreement with one of the largest mutual fund companies in the country, where that's basically all that all that brokerage firm sells is that one mutual fund. So think Vanguard or Fidelity. It's not them, by the way.
Okay.
And so they get a chunk, or they get a percentage of the fee. So they basically have an agreement to split anything that is brought into the brokerage firm. So if you buy a share in Walmart's mutual fund, let's say Walmart's selling mutual funds, that brokerage firm is giving part of that fee to the brokerage firm and keeping the rest. So you basically aren't getting somebody who's giving you the best advice, because they only have a few mutual funds to sell. So they're not going out and finding you the best mutual fund or investment that's available. They're selling you what they have to, and they don't even have to disclose this to you, by the way.
Right.
The SEC does not require them to. Typically, it's somewhere on their website, but you have to know what to look for.
Okay. So at Portia Capital, it's CFA. How do you get paid? If that's how they're getting paid, how does Portia Capital get paid?
I get paid a percentage of the assets that I manage.
Okay.
for instance, if I manage let's say it's $1 million account, I get paid 1% on that underlying asset. So if it's $1 million, I would get paid $10,000 a year. I do discount along the way. I need to give that caveat also. So I'm a fiduciary. So think about it this way.
Mm-hmm.
If your market value goes down, my fee goes down.
Mm-hmm.
If your market value goes up, my fee and my pay goes up. I don't get any commission. So whether I put you into a mutual fund or a private investment, something that's easy or something that's difficult, I'm going to do the best that I can for you so that your assets can grow. I'm not motivated by the fee or the type of investment I'm putting you in. I don't take any commissions. By the way, I can't as a CFA. That's one reason why I chose that, so I could be on the same side of the table.
Mm-hmm. So it's very much like with me, with my company, my mission. If I raise funds, I'm going to take a percentage of that. It doesn't. If the thing goes up, I make money. If it goes down, I make less money. It's just a percentage of the assets under management. Is that exactly? That's what you said, correct?
Yeah,
okay.
Exactly.
Okay. All right. Michelle, you had told me before that you are doing some social type things with your company, and I've read that you guys are investing 10%. Talk to us about that.
Well, I don't have children, and I also, throughout my career, I've been an educator. For the last 10 years, I've taught the CFA in Texas. I've also been a professor at University of Texas at Dallas, and I really have a penchant for helping children get to the next level and have that education. So with that in mind, I saw or became involved with a group here in North Texas, Education First Steps. We establish accredited preschools in Dallas and Fort Worth in marginalized areas because it's been determined through childhood education studies. You get a child early before the age of 5, you give them the vocabulary, have somebody read to them, and even provide them basic nutrition, which a lot of our preschools do. And you're going to give that child a lot more opportunities for education and that upside, and also keep them out of other areas of society that they may wade towards if they're not given that consistent education. And by the way, we also teach social skills from an early age in those organizations that they may not get at home, because most of our students, in fact, come from single parent homes from with a mother.
Okay.
And the mothers are just too busy, trying to keep, all the plates spinning. And so we kind of become like an extended family for those in those situations.
So are you building schools? Are you working with schools that are already there? How does it work?
What we have done is, more often than not, we go into existing schools where they're just basically set up by women that are running preschools that have had not a lot of training in terms of how to teach a child to read, teaching them basic vocabulary, and there are nationally accredited organizations that work with them so that they can become accredited, get the staff in place, and have something that's more of a cohesive model versus just parking children while their mothers are working. There's a big difference there.
Yes. I love that. And I know one of your desires is to get more women into financial management, more women CFAs. There's a very low percentage of women in this with that designation, correct?
Yeah. Well, I am the only female CFA to have a investment firm in North Texas. As of this year, I am the only female CFA to teach the CFA in the entire state. So it's actually dwindled.
Mm-hmm.
In general, the number of women going into finance, and I'm not talking as a financial advisor. I mean, somebody that's working at a mutual fund or working in a private investment field. The number of women has actually gone down in the last 20 years, according to Financial Times. Nobody seems to know why. I have different theories. Number one, I don't think that women, unless you come from a background of entitlement, which I didn't, by the way, you don't know about this field. You know, I mean, I don't know about you. I didn't know about what portfolio managers did or what Wall Street was when I was, growing up. I became familiar with it, but unless you come from an area of entitlement, you don't understand it.
Right.
Number one. Number two, women aren't comfortable with risk, and we underestimate ourselves. So there are psychological studies through Rice University in Texas that show have a woman and a man, you have the same intellect, basically they're making the same amount of money. A man will risk amount of money and believes what he takes to be more upside, and he'll take more risk for that upside. Whereas a female will sit in cash or do something has a lot less risk or riskless because they're so afraid of losing money. And that's where we sell ourselves short, is that we don't look at the upside. Yes, it's important to look at that downside and understand that part, that where men have us beat is that they are looking at the opportunity, and they always assume that they can gain that opportunity. Like with a promotion, women will always say, well, I don't have that one skill, so therefore I'm not going to go for that promotion. Men don't think like that. Men will just go, I'm gonna interview for that, or I'm gonna go buy Tesla and not understand what Tesla is. I've never heard of a woman just buying a basket full of technology stocks. Men do every day because they're just saying, well, it's going up, I'm gonna go follow it. Women need to become more comfortable with risk, whether it's a stock or whether it's a piece of real estate, or it's, investing in themselves and their own business. Men are much more comfortable with doing that. And we just cut ourselves short because we don't have that confidence in our abilities. And it took me quite a while to realize that I'm not just as good as the men around me. I'm actually better than men at understanding investments. But we always assume that we're less. When we're not. We're probably actually better.
I agree. How do you think we fix that? Is it a matter of getting more women involved? Is it a matter of that and get more education? But you have to take action at some point. So how do we get us to take more action?
If you're going to get more women involved, I think you probably know this as a doctor, you have to go into the schools at an earlier age, starting to talk to women and minorities about things like finance and investment shouldn't happen in college. From my point of view, that's already too late. You need to talk to people about the opportunities that you can put in front of yourself, by making these type of investments. Maybe not even, that doesn't mean you have to become somebody in investments or in finance, but why you should have this as part of your life, because that's going to give you the ability to have more freedom and more mobility as a female. So go into the schools at a younger age. And I also think it has to be more women going into the schools, because when I've asked women what they wanted, they said, I want someone like you talking to me. I don't want a white man coming in and telling me what I can and cannot do, because there's an intimidation factor there, and there's a lack of there's an apprehensiveness of not being asked to ask questions of that person. You want to see somebody who you feel is approachable and like you, that you have something in common with, whether it's color and or gender. And you need to see those individuals sooner when you're younger.
I like it. I understand you're going to have a webinar coming up pretty soon. Tell me about it. Let's get our listeners to be
Yes.
able to find you soon?
I'm looking at having a webinar before December 15th. The topic is going to be how you can look at your investments in your portfolio and plan for next year for that upside that I was talking to earlier. If you don't have an investment portfolio, how you could start thinking and planning for one as we're going into this new year. There's going to be lots of opportunities. It doesn't mean you have to invest big. Invest in what you know. I mean, I tell people that all the time. I mean, if you're a female, there are certain brands and certain things you understand. It doesn't have to be a technology stock. Can be something that you understand and you're familiar with. I mean, some of the best mutual fund managers in the world, that's how they got started, is investing in what you know. So that's going to be my topic, taking more control of your financial destiny, so to speak, as we head towards next year and out of the pandemic.
I love it. Everybody will have information about that in the show notes. So when you see that, please go and sign up for Michelle's webinar. I can't express enough how important it's going to be to move forward into 2021, get your financials in order, get your goals set, and let's move in and make 2021 the best year yet. Thanks, Michelle. I really appreciate it. We'll talk to you soon. Okay.
Thank you for having me.
You're welcome.
You've been listening to Money with Mission. There are projects happening right now where you can make a great return while positively impacting the lives of others. To learn more about today's guest or to download 7 steps to building resilient wealth for women, visit www.moneywithmission.com.